We like to put a lot of money in things that we feel strongly about, and that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses.
Diversification, that's for idiots, right? Because you can't diversify enough to know what you're doing.
I don't believe in diversification at all. I would own one stock if I could find one great stock. Diversification is a big mistake. I call it diversification.
Hey, I'm Stephen and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. So this video is about investing and diversification. I've been meaning to make this video for well over a year, but I've been a little bit busy trying to explain why I'm all in on Tesla stock and haven't quite had enough time to explain why I'm all in on Tesla stock. By the way, that actually makes sense. So in this video, I'm going to play a few clips from legendary investors including Charlie Munger, Warren Buffett and Peter Lynch sharing their thoughts around diversification, and I'll add my own thoughts and opinions where I think it's relevant. So let's get into the video. But first, hey guys, if you live in the US and you'd like to help out the channel and get up to 4 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 2 free stocks between $2.50 and $250 each just for opening an account. And if you deposit $100, you'll get a further 2 free stocks valued between $8 and $1,600 each. That is an obnoxiously good return on your investment. I mean, really, deposit $100 and you'll end up with, at minimum, $21 worth of stocks, a 21% ROI on your money. And if you're in Australia, the UK or New Zealand, you can get a free stock with stake also using the link in the description. Let's get back to it. And by the way, guys, just want to point this out because I know there's always a couple of boneheads watching. This video is not investment advice. One more time. This video is not investment advice. This is one guy on the internet sharing his thinking, his reasoning, and his decision making when it comes to investing. Nothing more. Use your own brain, do your own reasoning, think, even if it hurts, make your own decisions and act accordingly. I'm just trying to share my perspective and what that leads me to do in terms of my own personal investment portfolio. So let's get into it.
I don't believe in diversification at all. I would own one stock if I could find one great stock. Diversification is a big mistake. I call it diversification. You buy this thing that might balance this other thing and they both go down. My God, I got enough questions. I got enough questions to come at your 5th annual conference here. My God, I think we have enough conference. Thank you very much. Well, that's a pretty good one. So I don't believe in diversification at all. I would own one stock. But what I do believe in is if I find 10 good stories, they're all equally attractive, I buy all 10. And I wait to see them unfold. It's like watching 10 poker games. 10 games of stud poker. You watch the cards turn over, story 3 gets better, story 6 slips, story 7 stays the same but it goes up 50%, so you sell 7 and buy 2. That's all I do. So if they're equally attractive, I buy all 10. Then gradually some story says, oh my God, this is getting better and better, and guess what? The stock just went down. So you keep watching 10 stories and magically, because of that rule of stocks going up and down a lot, then you load up. You really, take a big advantage. So that either happens because something happens to the company or the market goes down and all stocks go down.
We just heard from Peter Lynch, one of the greatest investors of all time. In a 13-year period while managing the Magellan Fund, he saw annualized returns of almost 30%. Absolutely insane. And Peter's opening statements there, if he could just find one great stock, he'd be comfortable owning that stock. Well, I completely, wholeheartedly agree with Peter on that front. And I'd put my money where my mouth is. Those of you who've been watching the channel for a while will know I'm all in on Tesla stock. Over 95% of my stock portfolio by value is in one stock, Tesla. In fact, my level of conviction with Tesla stock became so great that I literally started this channel to try to explain to everybody why I saw so much incredible potential in Tesla stock and why for the past 1,772 days, Tesla stock is practically the only asset I've invested my cash into. Yeah, literally. Now, some will call me lucky, others will call me right. You can make up your own mind.
We like to put a lot of money in things that we feel strongly about, and that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses.
I just want to take a pause here. I wholeheartedly agree with Warren Buffett's points here. 1, diversification is protection against ignorance. And 2, most stock investors are actually incredibly ignorant, and it's probably a good strategy for most investors out there, because we know most investors end up losing money because they do not know what the fuck they are doing.
If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness.
Once again, Warren Buffett is singing my song. As I mentioned, for the past half decade, the best investment opportunity I was aware of, that doesn't mean there weren't other opportunities out there, but the best investment opportunity I was aware of and had a high level of conviction in was Tesla stock. And as we know, that worked out okay. Now, don't get me wrong. If I had identified an equivalent opportunity to Tesla stock, I thought, you know what, the risk reward's comparable, I have the same level of conviction, I would happily have invested in that as well. But I didn't. So I didn't. Pretty simple.
And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own 1 stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love it, the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is, you don't need it. I mean, if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses, and they'll be safer, incidentally. I mean, there is less risk in owning 3 easy to identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50. Charlie?
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
You want to elaborate on that, Charlie?
You cannot believe this stuff. I mean, it's modern portfolio theory, and yeah, it's.
It has no utility. But I mean, it will tell you how to do average, but I think anybody can figure out how to do average in 5th grade. I mean, it's just not that difficult, and it's elaborate, and there's lots of little Greek letters and all kinds of things to make you feel that you're in the big leagues. But there is no value added.
I have great difficulty with it because I am something of a student of dementia, and I have.
We hang around a lot together.
And I can ordinarily classify dementia, on some theory structure of models, but the modern portfolio theory, it involves a type of dementia I just can't even classify. No. Something very strange is going on.
Yeah. If you find 3 wonderful businesses in your life, you'll get very rich.
So the message there from Warren Buffett and Charlie Munger is fairly simple. Diversification is for idiots. Now, there's plenty of idiots out there in which diversification is a good strategy, but I am arrogant enough to think that I'm not an idiot. I do have the track record to back that up. So far, my investment track record is home run after home run after home run after home run. I haven't made many decisions. I haven't swung the bat many times. It's just when I do, the ball tends to go over the fence. This is because I'm not desperately running around trying to get 60 different stocks in my face to diversify. I'm instead sitting like a sniper with my scope, just waiting for an opportunity to get in the crosshairs, and when I find the right opportunity, and only the right opportunity, bang, I pull the trigger. Now, I know there's a few of you watching thinking, what an arrogant prick. You're going to be wrong one day, soon you're going to lose all your money, buddy. That's okay. Like I said, I'm just sharing my investment thinking, my investment reasoning, and my investment decisions. Make of it what you will. I'm not saying what you should do. I'm just telling you what I did do, why I did it, and what I continue to do in the future. In fact, here's my complete investing history. Between 2010 and 2015, every spare cent that I had went into Australian real estate. My strategy was quite simple. I had a 3-pronged approach. 1. Buy properties undervalued so I immediately make money and cannot lose money. If there's a train wreck, if there's a disaster, if I'm forced to sell, I will literally make a profit on day 1 because I bought undervalued. 2, buy properties in suburbs poised for strong capital growth. So over time, the value of that real estate is likely to trend up. And 3 was to always buy property that had the ability for me to immediately add value, either through development, subdivision, etc., or through renovation, refurbishing, etc. And for what it's worth, I more than 10x my capital within 7 years in real estate. Leverage definitely helps. And for the record, I still own all of that real estate. But up to that point, between 2010 and 2015, 100% of my net worth was concentrated solely in Australian real estate. And I was comfortable with that because I knew what I was doing. I had a high level of conviction, I did my homework, I had a plan, I executed, and I got the results. And my real estate investing exploits didn't go unnoticed. In fact, this brings us to my next all-in moment. This time, I wasn't all in terms of my cash, but all in terms of my energy, time, and focus. I left my design career, started a finance business to help other investors replicate the same kind of results that I had with investing in Australian real estate, and did phenomenally well under the guidance of a great mentor. Plus, I worked my face off 80 to 100 hours a week for 3 years. You'll get pretty decent results when you do that and you're competent at what you do. And what did I do with this newfound source of income? All in on Tesla stock. Now, the reason I'm sharing this with you guys is just to try and illustrate a point. I'm an opportunist. I'd rather sit on the sidelines and wait until I see an opportunity. For example, Australian real estate. I saw a huge opportunity, I went all in. Then I realized I had a huge amount of value that I could offer people. I transitioned out of design into finance, helped a load of people, enormously increased my income, and was able to retire financially independent as a result of that business in 2018. The point I'm making here is just to show my personal style of investment, whether it's investing my money or investing my time. I'm all or nothing. If I see a great opportunity, I look around, I can't identify any better opportunities, and I feel this opportunity is worth pursuing, I'm all in. But if I can't find any opportunities to pursue, I'll happily sit on the sidelines and wait. Like I said, I'm the sniper looking through the scope. If the wrong thing's in my crosshair, I'm not going to pull the trigger. I'll wait until I'm certain that I do want to pull the trigger, and then bam, headshot. And that brings us to this YouTube channel. Yes, it is about to get meta. So as I mentioned, I retired in 2018. Don't do it. I'm serious, guys. Do not retire early. It is the worst thing in the world. If you're anything like me, you will need a clear mission and purpose in life, and if you don't have one, the wheels will fall off, I guarantee you. So a couple of years ago, I'm retired, I've sold all my stuff, and I'm backpacking through South America, doing everything and everyone you would expect somebody backpacking overseas to be doing. The problem was, it got very old, very fast, I didn't know where to from here, so I decided to head to the jungles of Peru, participate in some ayahuasca ceremonies, and ask the question, where to from here? And that's where this YouTube channel was born. Long story short, started the YouTube channel, went relatively well, and I thought to myself, here we go again. This is my next all-in moment. And maybe you guys have noticed, one new video every single day for the past 7+ months. Haven't had a day off in over a year. In fact, I've been working my face off every waking hour, all of my energy going to this channel. Why? Because once again, I see an enormous opportunity and I am all in. Congratulations for making it this far through the video. Your reward? We're now getting down to the brass tacks, the meat and bones, the entire point of this video. When considering whether or not this all-in approach to investing, either investing your time or your money, makes sense for you, there's 4 key questions you must ask yourself. 1. What does your history of decision making look like? Do you have a track record of accurately predicting things about the future, acting on those, and doing well in terms of investing time and money? Or do you have a track record of striking out, or somewhere in between? This is extremely important. If you look into your past and see that you're an idiot in terms of your investment decisions, you keep making mistakes and making mistakes and making mistakes and not learning, you're out. Don't even think about it. And there's 2 elements to this. The first is the decision themselves, thinking and reasoning. Was I right or wrong? But there's a far more important point. Time. If you've been right for 1 month or 1 year, you haven't been right or wrong. You can't judge yet. It hasn't been long enough to have any idea whether or not you were right, or there was an anomaly over the short term that made you look right, or whether you were wrong. For example, I began investing in Tesla stock all in 2016 and 17 and 18 and 19, and over those 4 years, Tesla stock traded sideways. Many people laughed at me. All my friends and family, oh man, you're going to lose all your money. It's not doing anything. They're going to go bankrupt, rah, rah, rah. I had conviction. Turns out I was right. Took a little while to prove that out, and that is the point. You cannot judge your past decision making on a short period of time. The longer your track record of being right is, the better. The shorter, well, you don't really have enough information to be sure. So the first point, once again, your track record matters. My investing track record only spans just over a decade. Certainly this is decent. But just imagine if I'd seen these same returns and this same level of decision making over a 20, 30, 40 or 50 year period of time. Number 2 is your temperament. If you're somebody who's primarily driven by emotions rather than reason and logic, you probably shouldn't be investing in this kind of manner. If you're somebody who, for example, earlier in 2020 when everyone thought the world was ending, you made the genius decision to sell some of your stocks, not because you'd analyzed the situation, thought your way through it and come to some conclusions, but because you were scared, fearful, worried or uncertain, this approach is not for you. Number 3, your intellect. Now I know this may not be fun for some of you guys to hear, but I'm not here to make you feel good. I'm here to make you think. Now don't get me wrong. Temperament is far more important than intellect when it comes to investing, but they both matter. Be honest with yourself. If you're below average in terms of your intelligence, but you're aiming for above average results in investing, that may be challenging. Number 4, what's your goal? Why are you investing in the first place? What is your end goal? How much money? How much passive income? What are you actually aiming for? Why are you investing in the first place? I personally have relatively ambitious goals, and I aim on achieving them. Therefore, this dictates some of the actions that I must take. I've mapped out how much money, how many resources, how many people do I want to positively impact over my lifetime. I have a plan and I'm moving towards that. This is why I make some of the investment decisions that I make. If I was just aiming here, then maybe I wouldn't have gone all in on Tesla stock because I didn't need to. But I'm not aiming here. I'm aiming for the fucking stars. Maybe I don't get there, but at least I'll hit the moon. So, before making any investment decision, all in or highly diversified, ask yourself these 4 questions. 1. What's your track record? 2. How's your temperament? 3. Your intellect. And 4. Your goals. In other words, your past, your balls, your brain, and your target.
So
what are you investing in? What are the areas that feel you know?
What I did in 2008 and 2009, I put everything into MLPs and MREITs, mortgage-backed securities, ones that I thought were the better companies, and I just piled in. And I also piled into Australian bonds because I thought the economy was good next to China. It was my way of playing China.
So you make one-way bets. This isn't portfolio balancing you're talking about.
No, all that asset management, diversification, that's for idiots, right? Because you can't diversify enough to know what you're doing. Right? I mean, I did my homework on Australia, right? I did my homework on the MREITs. I did my homework on MLPs, and their pricing had just gotten crushed.
To sum this one up, in my personal situation, I do have a diversified portfolio of investments. I mean, I've got a YouTube channel. I don't know how to value that, but it certainly holds some value. I've got a past business that's paying me out every month, paying for all my bills and my living expenses, practically an annuity. I also have a bunch of Tesla stock, and of course, I also have some real estate. Now, the reason that I'm diversified isn't because I set out to diversify my portfolio. My diversification is a side effect of me pursuing opportunities where I saw them. Just so happens that for the first 5 years of my investing journey, 2010 to 2015, I was all in on real estate, then I focused on business, then Tesla stock, and now we have the YouTube channel. And my next all-in investment focus, the genomics space. As I revealed recently on this channel, I've established a position in the ARK Genomics ETF. The ticker for that is ARKG. I'm also making a bet, gambling in the casino, not investing. I also have some options on the ARK Genomics ETF. I continue to learn as much as I possibly can about the genomics space. Now, just for the record, guys, I didn't just wake up to this yesterday. In fact, I've been following progress in the genomics space for over 2 decades. Human Genome Project, shout out to Craig Ventall for beating the government. If you don't know what I'm talking about, do some homework. I've been following since then. In fact, almost a decade ago, I had my own DNA genotyped, learned a ton about ancestry, but far more importantly, and the core reason I did that, about health risks and other markers. I'm highly confident that if you put me in a room with 10,000 other people, I would know more about the genomic space than anyone else in the room. Yet still, I do not have that level of confidence and conviction to pick specific companies within the genomic space yet. That time will come, but until then, ARKG are the custodians of my capital because I truly believe there will be trillions of dollars of value created in the genomic space in the next 5 to 10 years. That's right, guys. Until further notice, every spare cent I have is now going into the ARK Genomics ETF. Once again, I want to reiterate, this isn't investment advice. I'm simply sharing my investment thinking, my investment reasoning, and my investment decision making. Be a big boy or girl, use your own brain, think for yourself, make your own decisions, and invest according to your temperament, your track record, your intellect, and your goals. And I'd love to know about how you guys approach investing. So let me know in the comments below, how diversified or not is your investment portfolio? And no, I'm not just talking about stocks. If you own real estate, business, or other assets, include those as well. It'll be really fun. No judgment here. I'm not saying what's right or wrong. Just wanting to hear some feedback in terms of how you guys approach investing. Like I said, just one guy sharing his investing thoughts, reasonings, and decisions. I'd love to see how you guys reason, think, and act in terms of investing too. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. And don't forget, if you live in the US and you'd like to help out the channel and get up to 4 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 2 free stocks between $2.50 and $250 each just for opening an account. And if you deposit $100, you'll get a further 2 free stocks valued between $8 and $1,600 each. And if you're in Australia, the UK, or New Zealand, you can get a free stock with stake also using the link in the description. Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. I read all your comments. P.S. If you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server, and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.